Hello, everyone. I'm excited to get started. I'm going to give everybody 1 minute until we hit exactly 12, and then we're going to kick this party off on the exciting topic of exiting your business. Something that we all dream of someday, I'm sure. All right. Anthony, how are you? Good?
I'm doing great. You know,
Awesome. All right, I'm going to get this started. So, hello everyone, and thank you for coming to February's roundtable, where we have a really amazing two speakers for you today who really know their stuff when it comes to selling your business. Before we get started, I just have a little bit of housekeeping, and I have an amazing video that I'm sure some of you have seen that I'm going to attempt to share because last time I tried this, I had technical difficulties. So, hang on, I already messed it up. I already messed it up, Anthony. Here we go.
it's all right. You
I
got
got
this.
this.
Don't worry.
You're gonna tell me.
There you
Welcome
go.
Are you saying it, Anthony?
Yeah.
to this month's New Jersey Business and Industry Association's Business Growth Roundtable. We created this show because we really want to equip you with what you need to succeed.
This event is ideal for business leaders who need to stay up to date on strategy, technology, and trends to grow their business.
So let's get started. Hello, everyone. I am Donna Miller, Chief Visionary Officer and founder at C3 Works, where for the last 30 years, we've been helping companies to accelerate their growth by providing advisory and support services around biz, dev, operations, and finance. What we do is we allow growing teams and companies to focus on that which truly drives their business forward. Our clients know that by bringing us in, we are going to build efficient, connected, and executable systems, whether they execute or we do, helping them to lay the foundation to build a company that will run and grow without them involved in every little detail. Want to talk about scaling? I'm happy to set up a call. And now let me throw it over to my fabulous co-host, Rachel Durkin.
Hello. Thank you, Donna. And my name is Rachel Durkin. I'm with Paradigm Marketing and Design. We are a web branding, marketing, and sales enablement agency that specializes in working with clients with a complex sale. So if you have a sales team and you want to increase the number of leads that they are getting and improve their closing rate and cycle, we can help build a marketing to sales infrastructure that will make that happen. And this event would not be what it is without our very amazing sponsor.
We are thrilled to have the team at Summit Place Financial Advisors join us as a sponsor. Summit Place Financial Advisors provides personalized financial guidance for successful individuals facing complex investment, tax, and estate planning needs. As an SEC registered firm, they work solely in the client's best interest, offering holistic advice without selling products or earning commissions. So we thank our sponsors.
All right. So now over to Anthony to give us some NJBIA updates.
Thank you, Rachel. Good afternoon, everyone, and welcome to New Jersey Business and Industry Associates Business Growth Roundtable. I'm delighted to be here with Rachel. Excuse me, this is an incredible initiative. It's led by such a talented group of women, and I'm looking forward to today's opportunity. Anyway, for those of you new here at NJBIA, we are the nation's largest statewide business association, and we represent about, 1/4 of all employees here in New Jersey. NJB is dedicated to supporting companies across the state and always guided by a core principle, business at the center. We also offer other opportunities here at NJBIA through our in-person events, such as one of our signature events, WBLF, and our virtual events that you can look at njb.org to check them out. We also have opportunities within our magazine and digital opportunities. We have our podcast, Planet New Jersey, and our television show, Minding Your Business. And we have other money-saving programs that can help your company for payroll opportunities, 401k solutions, healthcare, HR support, and also auto insurance with our partner, Plymouth Rock. So if you need any other additional information, please feel free to reach out to me. I'll put my information in the chat. Some upcoming events are taking place. We have our leadership series that's continuing with number 2, taking place on February 17th. The topic is going to be performance-driven leadership development. It's going to be a great opportunity for everyone to get on board to check this out. So for more information, please check out njb.org. And also I'll put my information in the chat, like I said. And now I'll turn this over to Rachel.
Thank you. Thank you. And
Got it.
one last thing, make sure to register for next month's event. It's going to be a good one. We're talking about from interest to impact, a better buying funnel. We're going to talk about how AI has impacted the way we all buy and sell today, and how we need to come up with new strategies and ways to leverage AI in order to make our marketing and sales infrastructure more impactful and, frankly, ensure that we're closing more deals and we're beating out the competition. So join me, Donna Miller, and Cal Thomas from Sandler Training as we discuss how to leverage AI in your sales pipeline to make your company more successful. I just put the registration in the chat, and I hope to see you all there. Now, without further ado, I want to bring Jason and Ron to the stage, who are going to introduce themselves and then kick off our topic for today. So Jason and Ron, why don't you join us? There's Jason and Ron. There you go. All right, gentlemen, I'm going to hand it to you. Let you introduce yourselves and kick things off.
Okay, great. Thank you. Appreciate it. And appreciate everybody for being here today. Today, we're going to talk about quite a few different topics, primarily driven by what the current capital markets look like as it relates to mergers and acquisitions, what the buyer side is looking like, and how it's sort of developed over the course of the last 6 to 12 months. And then we're also going to talk a lot about valuation, preparing companies for sale, and what's really the value drivers that we're seeing today, as it relates to a lot of companies. We're going to introduce ourselves here in a second, but I just want to encourage all of you to please, in either the chat box or the question and answer box, please ask questions that you have as it relates to either your company or just any questions you have related to, M&A in general. We like to focus on the questions rather than the presentations during these webinars to the extent we can. So any questions you have, please ask them. But without any of those right now, I'm going to share my screen for the presentation. Hopefully everybody can see that. Ron, can you see that okay?
Perfectly.
Okay, great. All right, so why don't we do an introduction? Ron, you want to start on your side and then I'll do mine?
Sure. A little bit about me. I started in the world of bricks and mortar retail. I used to own a national chain of art galleries and art and framing stores. I had 22 stores in 7 states with a couple hundred employees. Got out of it in the mid 2000s, took a few years off, got bored, decided I needed to be more productive. So I made an offer to buy a business. It failed due diligence. Made 3 more offers, all failed due diligence. Finally decided that if I was going to buy a company, it would probably be prudent to become a broker first and see it from the inside. So I became a broker. In the first 2 years, I did buy 2 companies, but I really liked the brokering side. Stayed with it. Met Jason not long afterwards. We formed this company, which now we have grown in our sector to the largest in the world.
All right, thanks. Again, my name is Jason Garataz. So I'm a former military officer and I'm an attorney. Started off my career as a trial lawyer in Kansas City and then shifted over to a general practice as general counsel with several different companies, primarily focusing on mergers and acquisitions in the public and the private space. About 15 years ago, I decided to stop practicing law and created my own company called United Commerce Group, where I began building and buying e-commerce and other digital brands. We got up to about 24 companies all in before we started divesting out of all of those. And now we focus on our mergers and acquisitions firms. Website Closers here is our largest firm. It's well known in the tech and internet space, also in other spaces adjacent to it. We also own other firms called Sellerforce, DealPipe, and Valley Biggs, which do all different things within different industries. So we can tackle brick and mortar, we can tackle tech, high tech, and a lot of other industries. And so we pretty much cover the gambit. We also own, and we'll talk a little bit about this later on in the presentation, a lending brokerage called Yaw Capital, where we help our buyers and our sellers to some extent get prepared for these exits through capital acquisition. Really important part of this process. And so, we'll talk more about that here in just a second. Again, the overview that we're going to be talking about here, we're going to talk a lot about SBA and how that impacts any business that's really below $8 million. And we're going to talk about, the capital markets above $8 million and what that private capital looks like and how a lot of people are getting access to that capital right now. We want to talk about preparing your business, both pre-exit and during the exit, as well as what it looks like in due diligence and how you can be best prepared for that. And of course, we'll talk about buyer interest and how we strengthen leverage in a transaction. Not just by the volume of buyers that we have, but by making sure that those are the right buyers for a particular transaction. So just as an overall market analysis right now, I mean, we are at a stage right now, from coming out of COVID, the highest that we have seen since about 2021. And I'm talking mostly on buyer side right now, but that's also occurring on the sell side as well, where we've seen a lot of business owners begin to come back to market. A lot of them had been on the sidelines because, a lot of them were in earnings recessions coming out of COVID. We had very, very high highs during COVID for a lot of companies. And then we saw a lot of lows coming out of COVID, and that year over year drop in sales and profit, made it difficult to sell a transaction because buyers wouldn't know when, the bottom was going to fall out, so to speak. And so that has basically stopped. And right around 2024, we started seeing leveling out of companies. And that became the new foundation for growth. And so last year we saw pretty solid growth across the board for most of our companies. And this year, once again, the folks that came to market here in January, which is very common, we see a lot of companies come to market in January. Almost all of those were growing compared to what we had seen over the prior years, where so many of them were, on a year-over-year basis, dropping coming out of COVID. So it's become an environment that there was already strong buyer interest, but now it's become an environment where these sell side mandates are starting to get higher multiples. They're starting to get a lot more interest and a lot more offers on them, as we go through. There is still a buyer prioritization as it relates to a high quality business, and we're going to talk a little bit about what makes a company more valuable than others. But that certainly is important to buyers right now. I mean, they are trying to get debt and equity, behind the scenes in order to buy these companies. And it's important for them that they're finding quality here. And so we're going to talk a lot about that here in this presentation. Premium assets still command premium outcomes. What we mean by that is there are certain industries that are more important to other industries. As it relates to buyers, business services, as an example, is one particular industry right now that is very interesting to buyers. Anything that has a high recurring element, low churn with respect to loyal clients, those are the kinds of things that are premium assets at this moment. Or maybe it's something that has a high level of intellectual property or just proprietary nature to maybe the tech stack that it has, or it has other moats that help protect it. These are premium assets that are, we're seeing with those particular assets, we're seeing high particular multiples. And then preparation, not hope. That, of course, is something that we preach in all of these webinars, is that you need to prepare your business way before you decide you're actually going to go to market. And there are certain steps that we'll talk about here about how to do that. That remains the same, here this year. Things like setting up your financials and making sure that they're market ready. Making sure that you're talking to a broker, whether it's us or somebody else, early on to make sure that you are checking all the boxes for those valuation formulas. And there's certain things that, if you check all those boxes, you can almost assure yourself that you're going to receive a better valuation down the road. Ron, you want to talk a little bit about what makes a valuation premium?
Sure. Now, we'll start with every seller believes that their company is the best one out there. It's worth $1 gazillion, and every buyer is going to love it. The reality is there's a lot of different reasons people choose companies. We'll start with the first one. Having an infrastructure behind you, a strong team, people in place to do the jobs. The more a seller is involved in their company, the less it's actually worth. The reason why is because the buyer comes in and sees this is, is this company being driven by the seller? Can I replace the seller? The seller's got a lot of knowledge and goodwill that I don't have. They have experience that I don't have. When you have a team, it gives comfort because that team, you got to hope they're going to stay. But based on that, you've got a lot of strength there. Now, here's a couple of examples. We're representing two companies right now. One of them is over 10 years old. They have a very deep pool of people. Now, this company has got a strong value because of its tenure and because of its infrastructure. However, the company's been dropping for several years. It's got it was up this year, but it was up because it laid a bunch of people off. Okay, now despite all of that, there is a lot of interest in this company. We're getting a lot of offers for it, and we're going to get a good multiple on it, even though it's got problems because of that deep infrastructure. Now, you compare it to another company we're representing right now, and it's a young company that's 3 years old. However, its growth is off the charts. It's doubling year over year, both top line and bottom line. You've got two people that are owners. They're running this company. Now, everybody's looking at this company as though very high risk. Its financial performance is actually way better than the other one. But the bottom line is people say, I have to duplicate two people. So I either have to hire or become these two people. And so it kind of scares people away. Now, if you're coming to market and you're going to sell your company, you might want to consider in advance hiring people that you can start to train to do your work, even if they're not up to your level. When a buyer sees that you have a few people, they're a lot more comfortable than thinking they've got to replace you with all your experience and goodwill. So believe me, I would put a lot of emphasis on that before you came to market, and I would focus on that way in advance. Low concentration risk. Now, we see this frequently, but companies have these big clients that represent a lot of their revenue. Now, they look at it like this. They say, well, this client's been with me for 4 years, 6 years, a long time. They've grown every year. There's no reason this client's going to leave. Okay, but a person coming in is looking at it completely different. They're saying, okay, I got debt service on this company, and that debt service is going to be really high. So if this person were to leave, I mean, maybe they don't like the way I look or the way I talk. Well, I don't know if I can even make debt service afterwards, much less pay myself. So your risk goes way up. Now, the reality is, okay, we had a company we represented last year, and we had 30 some offers on that company. But the reality is they had lost a big customer right as we began the process. And they disclosed that. But when you really sit down and run the numbers, and the example is this, they received an offer they accepted for 6 million. Along the way, the buyer came in and said, you are losing this big customer. We only see this company now is worth 2.5 million. We're resizing our offer. Now, even though the TTM was really strong, you project forward 12 months, and that's all the cash flow they had on it. Now, the seller's argument is real simple. What they're saying is, well, wait a minute, we get new clients every month. So shouldn't that offset some of the loss? And the answer is yes, but you just lost a big client. So while you're looking at it as not that big of a risk, a buyer's looking at it as a huge risk. So you really want to focus on, if you've got a high concentration in one customer, you have to understand you're going to get dinged on that on your valuation. Recurring revenue. There's companies, which are most of the companies that are out there chasing revenue every year. So they're looking for new clients over and over and over and over, and that's how they make a living. If you have recurring revenue, that becomes a different company. People view that as though there's safety in that recurring revenue. Now, it also depends on how sticky it is. If it's revenue that's coming in and it's good for a few months, that's good, but not great. If it's clients that stay year after year after year, and if you've developed a system that would make it very hard for them to leave and go elsewhere, then it's even more valuable. And so the more you can focus on anything that involves recurring revenue, there's a lot of people that are out there now trying to develop subscription revenue. We just sold a company in December that does exactly that, where they, basically take the customers of a company and they try to create some kind of exciting event every month that you would want to repurchase a product from them. And it's working very well. So, look to see if there's ways you can create recurring revenue for your own company. They're also going to look for, when it comes to valuations, what the growth trends are. I mean, if you're not growing, that's tough. Now, what Jason had just mentioned is that there was a event with COVID where everything shot up in 2021. A lot of companies in the next couple of years afterwards did decline. And so, we've seen that for a while, but anybody who's got growth, that is a really big plus. Now, the TAM and scalability. If you when a buyer jumps on the phone with you, they're going to ask, okay, what would you do with your company? And these are things that you've got to, where does the market go? Can you jump into something else that's going to add revenue to this market? What can you do to scale it? The more that you can define, the higher the value goes. You've got to be able to picture this in the mind of a buyer that, he's got to look at it and say, yeah, that makes sense to me. I can do it. And if you can do that, then you will get a better valuation. So these are all things that in the months before you're going to begin to come to market, start focusing on things like this. Now, one of the things, and I think we probably should put a couple of stars next to the next one. Ownership involvement pre and post sale. Everybody who buys a company is afraid that, how am I going to be able to run this? How am I going to learn it? How long is it going to take me to learn it? Most people, if they were to go through a 2 or 4 week class, they would retain maybe 70% if they were lucky. And so everything that you can do to create a transition period after the sale, particularly that will give comfort to a buyer, is vital. That is the one thing you want to be able to stress the entire way through the process is that, I can show you exactly how to do it. Some people create, videos of each task they do. And that way a buyer doesn't feel like, okay, I know he told me this during the training, but I forgot. Now I got to reach out to him and ask again. And so they get embarrassed. The best way to do this is to create it so that it's a no-brainer, but put a lot of emphasis on this because it's major. Brand versus business. Now, everything that you do, whether it's the name of the business, or the name recognition, we should say, or whether it's the brand you carry, anytime you've got that kind of recognition, it makes the business more powerful. And so, everything you can do in the way of social media, getting the word out there, everything counts in this particular department. The last particular point on this is clean financials. And I think this is probably something we should put on every single page because a lot of companies come to us and it's shoebox accounting. And you ask them if they have a accountant and they say, yeah, I did, but I fired him. I got to get somebody new and that sort of thing. And believe me, that's going to hurt you because you will go through due diligence. And the more data that you can provide, the cleaner the data, the more easy it is to understand, the more your company's worth. And when you go through a due diligence on financials and they can't understand it, oftentimes they're going to turn around and they're going to say, you know what, this is all we're going to be able to offer. We're going to have to lower our offer on this because there's certain things we just don't feel that they're clean, they're understandable or valid. So those are some of the points on valuation.
Yeah, I just want to touch on the pre and post sale note regarding owners and how they think about these things. And a lot of times, owners don't put a lot of thought into this and they come to us and, they want to sell their business and they want to get out as fast as possible. And, that is a mistake. What you do to make the buyer feel comfortable in this process can increase your valuation tremendously. And it kind of depends on whether or not it's a below $5 million company or above a $5 million company. Below $5 million, we generally call those, really it's 7 million. We call those SBA transactions for the most part because 90% of deals in America below 7 million go the SBA route as long as they have good tax returns. Above that, it's usually you're using the capital markets and how that impacts a buyer's or seller's involvement in the process is important. For SBA transactions, usually you're going to be asked to stay involved in some capacity up to, maybe 4 months, something like that. So usually the way it looks is that the first month, you're heavily involved with them. You may even be at their location or they're at your location and you're really doing a full, here's everything, a full dump on here's everything that we do with this company. Let me show you, when I log in here, this is what I do. Every single hour usually has an agenda to it so that you're showing them step by step how you manage this company as an owner. Now, to the extent that you have a team in place to help you with this, it makes your job much easier, right? Because you might be focused on being, focusing on leadership, focusing on growth, focusing on the things that are going to help this company scale. rather than the actual operations themselves. So whether or not that's you or not, you have to dictate here. But if you are heavily involved in the business, you need to make sure that you're able to be prepared for that full transition after closing. If it's an over, call it $7 million transaction, in those cases, a large majority of the time, they're going to ask you if you want to roll equity, or if you want to retain equity in this business. And the reason why they're doing that is because for most buyers in that space, private equity groups, family offices, hedge funds, they really want you to be involved in some capacity after closing. And so do the debt and equity providers behind them. And so to the extent that, you're going into this sale process with an understanding that you're probably going to be needed for about a year, and you're flexible as it relates to that, you're going to be in a better position to sell your business at the highest possible valuation, because that's what buyers want to hear. They want to hear that you're going to be for them and actually involved in the business after closing for up to 1 year. After 1 year, even if you've rolled equity, you could potentially go to the board or into a consulting role or just move on. But by then, whoever the buyers are, they have had the opportunity to fully transition the business and they feel comfortable. And so, when you're on these buyer-seller calls, when it gets to a point where you're ready to, sell your business and you're talking about selling your business with a buyer, you want to make sure they are comfortable with the process, that, you consistently and constantly bring up that you're going to be there for them. You're not going anywhere. This is your baby. You grew it, and you want to make sure that, it does really well, post-closing. So to Ron's point, that is the most important item on here. And it's something that we see a lot of owners struggle with, throughout the process. And honestly, if you know a broker or you want to talk to a broker about it, I highly recommend doing that as early as possible. That way you can align, your living requirements and how your lifestyle is to what it's going to look like after closing, and make sure that you're going to have that flexibility to make sure you maximize your valuation. Want to talk just a second about why two companies at the same level of EBITDA may have different prices. And we kind of teach this in our school too. We teach business brokers, how to be business brokers. And this is one of the things we talk about a lot. Why is it that one company that has $1 million of EBITDA have a different valuation completely than one that doesn't? And so one of the, usually what we talk about here is growth, right? Growth can make a big difference in the valuation of your business. And so that's why they call it a growth multiple. To the extent you're going to market when your business is on the way up, that's the very best time to do it. And you're most likely to have a growth multiple for your business. You might have a multiple for $1 million business in the 6 to 8 times range, versus one that's not growing. Maybe it's flat. That might be closer to 4 to 5 range. Or if it's dropping a little bit, that could drop as low as 2.5, 3 times to, maybe 4 times. So when you're dropping, it becomes a much different scenario than when you're growing. A lot of other things go into it, of course, besides that, including the risk profile. Risk profile is a very broad way to describe a lot of the things Ron mentioned earlier, things like concentration risk. Do you have recurring revenues so that we know that we're going to have steady levels of cash flow to pay off our debt service? Because remember, when someone's buying your company, 90% of the time, if not more, they're going to be using debt. And right now, debt is a little bit more expensive than it has been, since example, 2021, debt was very cheap. You could get interest, you could get loans at 4% back then to buy a company. Now it's closer to 10%. So when that happens, that means that more of the company's profits are now going to debt service and interest than it was before. And so the fact that you have, cash flow that's steady and constant and consistent is really important. So if you run a business that's very lumpy, maybe it's heavy in Q4 and Q1, 2, and 3 are more difficult. We may have to talk about, leaving more money in the business when it sells. So that they're able to have the working capital necessary to get through those other months before they get to Q4, the next period. And also the timing of exit as it relates to a lumpy business could be important too. So you want to make sure you talk through that with a broker and understand what that timing should look like if your business is lumpy. But the best thing to do, of course, is to try to go into adjacent verticals or other opportunities where you lower that risk profile, you become less lumpy, and you try to normalize cash flow over a period of time. So again, you could have the same level of EBITDA, two companies, but if one has lumpy earnings versus another one, it could be difficult. Another one that we talk about a lot is narrative framing, and that really is something that you do with your business broker. As you're going through the process, you need to make sure that you have narratives set up for all your positives and all your negatives. And every business has a negative. Doesn't matter what kind of business it is, it has them all. But it's how you frame it and how you're prepared to manage that through a transition with the buyer. For the way we teach all of our brokers at our firm is to be upfront and transparent with everything, including all the negatives. That's important because as you're going through the process with a buyer, they need to have trust with you. They have zero trust with you on the first call. I can just tell you that. Buyers do not trust sellers because they're afraid that they're going to hide something from them, that there's some nuance that they're not aware of. There's lots of things that go into that mistrust, but over time, that trust begins to build as you go through the process, and the more transparent you are, the better. So how you narrate that and build trust is important, and it really is an important part of making sure that you're maximizing your valuation. And then finally, preparation drives leverage, and we've talked about preparation a lot here. The more you're prepared with things like what Ron mentioned, where you create videos of your SOPs, you have manuals created, you have actual printed SOPs, and everything is basically in a position where it can be handed off to a buyer on the day of closing. If not before, where you begin some of the training before, they're going to feel more confident that this is a business I want to get into. And I'm excited to get into it because I know that person's going to be there for me after closing. Ron, I think you want to talk about this one a little bit.
A couple things on this one. First of all, when it comes to financing, there's a lot of money out there. There's no shortage. If the company is good, we'll find a buyer. If the company is priced right, we will sell it. Understand that when you create a value for a company, one thing everybody's got to understand before we even begin is that you're going to borrow, most of the buyers, almost all of them, borrow money to buy a company. Even people with cash borrow money to buy a company. So what they're looking at is, okay, if I buy this company for this amount of money, what is my debt service going to be? And if the company's priced too high, they can't even pay the debt service. So all they're doing is saying, well, wait a minute, my debt service is almost as much as you make. So that's why a company has to be priced well to start with. Now, the different forms of financing that are out there right now, for up to 6 million, maybe 7 million, you could probably stretch to on SBA financing. That is a very, very common way to buy a company. Now, what that involves is the SBA loans 75% of the value. The buyer usually puts up 10%. If there's a lot of competition for a company, then maybe somebody's going to come up with a little bit more on the cash side and it'll be less on the seller note side. But typically you're going to see 10% from the buyer, 75% from the bank, and a seller note for 15% of that. So that's how an SBA transaction is going to look, when you're financing through that mechanism. Now, keep in mind that the SBA, unlike the capital markets, uses tax returns. Really what they want to do is they want to see 3 tax returns. They've got to have at least 2 of them that can cover debt service. And as long as you can do that, then you're pretty good. In some cases, not every bank is the same. So whereas one bank may turn down a deal that doesn't cover for 2 years, another bank may say, well, you've got such strong growth in the last year and this year you're way up. So we're comfortable with not having 2 years of coverage. So understand that we're telling you what the rules are, but the rules are flexible. If you get a really strong buyer in there, the buyer, may have pretty deep pockets himself. He may have global income, which means another company that's spinning off cash. Well, at that point, then they'll really stretch the rules. So, but typically that's what you're going to see. The next thing you're going to see is the capital markets and private capital. Now, understand that when somebody's paying cash for a company, it's real simple. They're going to try not to pay a dime more than they have to in cash up front. The reason why they do that is they're working with their own money. Just to make math simple, let's say it's a $1 million company. I'm putting down 10%. That's 100,000. Okay, well, that means I'm not really putting down much of the value of that company on an SBA loan. On the capital markets, you're putting in your own money. So in those ones, we're typically seeing maybe 50 to 60% that are coming in as cash. Now, It doesn't mean that there aren't people that, they get aggressive. If there's a lot of competition for a company, then people tend to pay more. But more often than not, that's about what we see. 65 might be the cap on the top end. So that's what we see on that end. Now, be prepared, especially in growing companies or sometimes shrinking companies, to have to do creative financing. Okay, and those can be earnouts, those can be a lot of different little things that they use to try to hedge their bets when it comes to being creative. So we see all of it. You might see something like, okay, we're going to have a 10-year amortization with a 5-year balloon. Okay, that keeps their payments low. They may also slip in one that says you need to hit a certain sales performance or seller's discretionary earnings performance before we actually make that payment. And so that's where they start to get a little bit creative, and they want definitely to, hedge their bets on this to make sure that they're not getting in over their heads on something that is already maybe slightly distressed, or in some cases, a seller wants to sell because they're doubling every year and they think it's worth, I'm going to double this year, I should be paid on that amount. Well, believe me, you may be doubling every year, but that's going to stop eventually. You're not going to double every year forever. It may stop next month. You don't know, and a buyer doesn't know. Some of the common deal structures we see, we just talked about the SBA, we see usually 10%, 15%, 75%. What that leaves you is 85% of the closing table on your cash. Now, that's a great scenario. Anytime you can walk away with that amount of cash at closing, it's awesome. We have a lot of sellers who come to us and say, I want all cash. End of story. I want all cash. That's, I mean, most buyers are never going to do that. They need you to have skin in the game. They don't know what you know, and they need you to be, to be productive after the sale and to help coach them and to be there for them. And so if you have some skin in the game, that protects them. On the capital markets, it's a little bit different. Oftentimes, you're going to see a component of cash. They love to see equity. A lot of people say, yeah, I don't think I want to carry equity on this company afterwards. But what we coach is that we're going to bring you a lot of really exciting buyers. And some you may not be so excited about in keeping equity. Maybe you're just not in sync with them. You don't, maybe you don't like them that much or something else. Others you feel are highly creative, highly skilled, highly experienced, and they're going to drive your company afterwards. And if that's the case, then, keep an open mind, because your first exit could be, X amount of dollars, and your second exit holding maybe 25% of the company could be bigger than what you got the first time. And so we really stress holding, keep an open mind on that one, because we've seen some, like we have one company recently that resold at 27 times what they paid for it. Now, how do you think that would affect your pockets if you had kept 25% of that? There's other things on the capital markets that you will see. You're going to see earnouts. You're going to see the seller note. You're going to see cash, and you're going to see equity, and sometimes some hybrids. So but right now I would say this when it comes to financing, and we've been through some really tight markets before. Right now it's really good.
Yeah, and just to reiterate for some of you that came in later, if you have any questions, we're running on, it's 12:40 right now, so there won't be a whole lot of time left as we go through this presentation. So if you have any questions, please ask. It doesn't really matter what it is. It doesn't have to be on topic here, just anything related to M&A, happy to answer it. I see somebody is asking for copies of the slides. Definitely we'll make sure that you get copies of the slides in the video. I see someone else asked that too, so no problem. So I'll monitor for questions. I hope they come in, but we will continue here. So what kills deals in due diligence? This is an important one for me. I actually wrote a book on it. I think it's really important that you think about things like this as business owners before you go into a process. We talked about messy financials, but this is a very big problem with a lot of companies, and it doesn't appear to matter whether it's a big company or small company. We see messy financials a lot. Where do people mess up on financials the most? Well, one is that they don't actually get an accountant involved in doing monthly financials. So we recommend that you do this from the very beginning. Why? Because when the buyer comes in, they're going to want to see trends. They're going to want to see many years back. That might not be necessary for the analysis of the valuation of the company, but they want to see trends all the way back. And so if you don't have those financials, or maybe you were doing, cash-based financials one time and then accrual-based financials another time, and then you switched accountants 3 times and then everything sort of got discombobulated, that's not going to be very helpful to you when you're selling this business. And so our recommendation is, obviously a lot of you aren't startups, but try to do it when you start up. And if you haven't done it since startup, start it now. Start it right now. It's not very expensive to find, someone like Bench or someone like that to do your financials on a monthly basis. Most of them are, actually they go directly in via API into the banks, the bank accounts, credit card accounts. So a lot of times there's AI doing a lot of this stuff in the background with just one analyst sort of making sure that we're, getting the right journal entries in place and those kinds of things. So really important that we keep them clean. And along that same line is if you're a CPG company and you hold inventory, make sure you have the correct cost of goods every month. So you're doing regular checks, regular counts, because what we see a lot of times is folks will come in and maybe they do a one check at the end of the year. That's okay. We can deal with that because we can still glean what are the accrual based earnings of the company by doing that. But to the extent you can do monthly checks or quarterly checks, it's even better for you. It helps provide that stability in cost of goods. It's really important when it comes to a CPG sale. Before I go into the next one here, I see a question. What SDE EBITDA multiples are you seeing by industry? Well, we operate, I think the last I checked was in 28,000 industries. So I'm going to do this at a very high level for you. We'll start with tech. And when I say tech, I mean things like robotics, AI, tech-enabled. SaaS would be inside of tech. IT, MSPs, companies that are digital in scope, that are technology based. They usually have a tech stack. These kinds of companies, if it's a growing company, it's got strong recurring revenue. It's got low churn. These companies are, again, depends on the level of EBITDA, but let's say that you're 2 million of EBITDA. These strong companies that have those elements that I just mentioned are going to be somewhere in the 6 to 8 range on average right now. That's what we're seeing. We have an e-commerce company that's mostly e-commerce. It's D2C, and it also sells at retail and also to governments and organizations. They've got 12.5 million in earnings. That company is currently at market at 12 times EBITDA. I think it probably trades closer to 11, but that's about the multiple that we have on that one. So you can see how level of EBITDA can certainly dictate where your valuation range goes. On business services, those have grown over the last 4 to 5 years. People have started to transition into business services. They really like them because it has the loyal customer base. It has recurring revenue, and it's not necessarily consumer focused. So, those kinds of business services, think of things like, shared CFO, shared CMO, accounting firms, law firms, anyone that provides business services of any kind. Those are the ones that a lot of buyers are gravitating towards and looking at. And also a lot of banks and equity investors behind the scenes really like those businesses too. So we're seeing those go up to the 6 to 8 range as well, as long as they have a nice, strong, growth trend. EBITDA levels, somewhere between 1 and 3 million. If your EBITDA levels below 1 million, I would say that you can drop at about 1x in multiple. Going up to that 1 million level, that kind of is the identifier. So, and again, I'm using very broad strokes here. It's important that you understand that, you kind of got to dig in by company to really understand the business well. It's not just the EBITDA or the SDE. It's also this operation. It's all those risk profiles that we talked about. Did we check boxes like we talked about? All of those things are really important to see in this by industry. And again, whether it's us or somebody else in the business brokering world, you want to go and talk to them early on to understand your particular business. And maybe you have a number in mind. Maybe this is something that, you've decided that I want 10 million for my business. And right now you've got 1 million of earnings. So that's a 10 times multiple. Is that realistic for your business? Maybe, depending on growth trends and whether or not a discounted cash flow model can be used based on the growth of the business, whether or not you've got some intellectual property or something else about your business that makes it stand out, that could be valued at 10 million today. But it also could be valued at 5 million. And this goes to that point that I made earlier that You could have the same level of EBITDA, but completely different valuations for a company. So you really need it to be analyzed. And then, something else that's, really, in the hands of a broker is what does the market look at for your particular industry right now? What industries are hot? Things like pet, kids, again, business services. These are the kinds of things that, you see them and MSPs. There's particular kinds of companies that, as soon as they come in, they're going to be very interesting to somebody. Like we're getting ready to launch a company that provides leads to lawyers. And, it sounds like a basic, simple business, but it's a highly recurring business in that the lawyers that buy from them consistently and constantly buy from them at a rate of 90% plus. So that valuation for that company, we're right at about 7x for that business because it has some of the elements to it that make it great. So I don't know if that answered your question or not. Hopefully it's Tavio. But if you have more questions on that, I'm happy to answer them. But really, you kind of need to talk to a broker to fully understand that. Back to what kills deals, but I'll be monitoring for questions. Unsupported ad backs. So it is not uncommon. In fact, I'd say very common for a seller to come to us and say, I'm adding back half of my company because I don't think any of these things are expenses a buyer will have. Well, in some cases, that's fine. If it's, your own salary that you've decided that you want to pay yourself, benefits that you pay yourself, 401k that you pay yourself. Maybe you like to travel on the business. That's very common for a company to have those kinds of ad backs, and that's all fine. And we see that every day. And all the banks agree those are ad backs. Those are definitely discretionary. That's the definition of SDE, or seller's discretionary earnings. It is discretionary to you. A buyer will not have to have it. On the other hand, there are many things that are added back by a seller that are not reasonable. Things like marketing. Let's say that you decided that we're going to try out Meta for 6 months. We A/B tested a bunch of marketing. We wasted $400,000 doing it. Well, we're going to try to add all that back because we decided not to stick with it. Well, the buyer doesn't know how much revenue actually was generated from that. And not just from the meta ads themselves, but from the halo effect into other places where they could have found you. And so there could have been a halo effect. There could have been a lot of things that happened because you did those tests, and the buyer will never be able to figure that out. And they'll immediately throw that into a risk profile and say, we won't support that. And also a bank would never support that. So you need to be careful with that. Another one that we see a lot of times are cost of goods. People try to do different things with cost of goods. You cannot mess with cost of goods. This is your inventory. This is your beginning inventory. These are the sales. This is your ending inventory. This is where your cost of goods are. And so, we can't really manipulate that at all. And other things, we would have to talk about on a business by business basis, but just understand that if you're adding a lot of things back to your business, it's normal, but don't try to hide it, in journal entries and those kinds of things. Just make it clear. We even recommend to have a net operating income line, and then below the line, do other income and other expenses. That way it can be very clearly identified by your accountant and all monthly financials, what is an add back and what isn't. Just put that below the line. We'll be able to use that during the sale process, and it'll be very clear. Owner dependency. A lot of times it doesn't become very clear early on in the process before you get into diligence that how dependent the company actually is, on the seller. And so it's important that you and your broker, whoever you work with, make sure that's very clear and evident up front before you sign an LOI. You don't want to get into the middle of diligence because it takes a while to figure that out. Because the first thing they want to work on in diligence is your financials. They want to understand the financials of this business and make sure it makes sense to spend any more money on the company with lawyer fees, due diligence experts, tax experts, all the people they need to hire to finish the execution of this acquisition. They don't want to hire them unless they know the financials are right. So that's where they're focused at first. They'll do a quality of earnings report as an example. But the owner dependency comes out in the operations side of it after the operational diligence. And they start realizing, wait a minute, I'm going to try to step into this person's role, and they are the entire business. Everything runs through them. They're making decisions, as an example, with Google Ads that I don't have any idea how to do that. And I'm afraid that I might not be able to hire for that. Right. So identify all those things where you have dependence, the company has dependency on you. And there are going to always be things with a business owner. unless you're running $100 million revenue company, then maybe you've got a CEO in charge and you truly are, away from the company. That's probably not the case with anyone on the call here. You're probably going to have some dependency. And so, lay that out with the broker, be clear about it, and be transparent upfront before you sign an LOI so that you don't get into diligence and waste a bunch of time and energy and also lose the buyers that also were interested in the business before you decided on that particular buyer. Make sure you figure all that out. Posted earnings versus QV earnings. So again, a lot of buyers think that, not a lot of buyers, some buyers think that they can manipulate their earnings in different ways with journal entries and so forth, and they'll never get caught. Well, it does get caught. It gets caught every single time. And usually a QV is done by a third-party CPA. So they're going to dig into all of your financials and figure everything out anyway. So it doesn't make any sense to try to hide. Again, that's probably 10% of sellers, but I have to say it anyway, just because we do get people that come in. As brokers, we don't do a diligence of your financials. It doesn't make any sense for us to do that. We're relying on the seller to provide us, financials, and hopefully their accountant to provide those. But the Q of E will actually identify all the true add backs. It will identify what the cost of goods actually are and really dig in deep to understand those things. And then finally, I see a question came in, but I'm going to do this last one here, personalities. I've got, I think, 3 chapters on this one. And I can tell you, as business brokers, a lot of our job is psychology. A lot of our job is, trying to relax people a little bit that are getting stressed out in this process. It happens with buyers and it happens with sellers. The buyer may be putting their entire livelihood on the line, their house, they maybe have kids in diapers. They're leaving a job that's a very nice, high 6-figure job or whatever. And now they're going to go become a business owner. They're going to have debt service. All these things can be stresses on them. And as they go through the process, little risks tick up here and there, and their overall temperament may start to go. And so everyone has different personalities, and some of them come out in different ways during the process. And so you as a seller need to try to, separate yourself from, those kinds of things. Have the emotional intelligence to have your broker have a lot of those conversations with the seller when things come up that you think are going to upset you. And that will happen. There will be things that upset you, and you just have to, kind of work your way through it. But that's one thing that really can break a deal in due diligence is when people get upset at the process. Maybe they feel like it's going too long. Maybe they feel like they're going in too depth or they're not listening. There's lots of things that can happen. So lean on your broker and make sure that they're really the ones having those tough conversations with buyers and not you. Because again, as we talked about, you're going to be a partner with them for a period of time during transition. It could be 2 months, could be 3 months, could be a year, depending on the kind of business and the kind of acquisition. I have a question here. Can you provide an overview of trends related to businesses for sale, the amount of businesses on the market today versus, say, a decade or 2 decades ago? Yes, definitely. So I started doing this about 2 decades ago, and Ron, I think you probably did too. Mm-hmm. I'll provide a couple of comments here. I mean, one, I think that there's far more companies not only on the market, but available to be seen on the market. We, as an example, we have 1.4 million buyers following us globally. We are a global franchise. And so, we see transactions all over the world. And I can tell you that in times when they're good, like right now, there's so many businesses for sale at market that it can actually negatively impact a client that's trying to go to market, because there's a lot of noise out there for buyers. Because if you, as an example, if a buyer comes in and goes, I want to put $100,000 down on $1 million transaction, I want to make sure that I'm getting the best bang for my buck and the best structure possible. If one seller says, no, I need you to put $200,000 down in, and I don't want an earn out, or I want the note to only be 2 years because that makes the most sense for me, and you don't have that flexibility, what ends up happening is that they go to another deal because there's so many transactions out there, they can just jump to another transaction. So it's important to understand that there are a lot of businesses for sale on the market. I will say one thing, though, there are not a lot of great businesses for sale. So if you do have a great business, something that checks a lot of the boxes that we talked about before, is fully prepared for the market, you have a seller who does very well with their narratives during the process, that business is going to stand out and do better than the vast majority that are out there. And this is a hit to the overall business brokering world, because I was a buyer before I was in the business brokering world, and I can tell you that there are a lot of not very good brokers out there. And if any of you have ever tried to buy a business, you know exactly what I'm talking about. You know, you're getting NDAs back upside down if you even get a response. You know, you're trying to get somebody to talk to you, and you know it's 4 or 5 days before they can have a chat with you, or they just don't show up. It's a real problem. We hear it every single day in our business, and one of the things we train all of our people on is to make sure that, you know, customer service for us is first and foremost, at both the buyer and the seller side. And so we try to do as best we can there. But I can tell you that it's difficult, you know, to the point here of buyer demand right now. Ron and I launched a business not 2 months ago. We had 500 NDAs signed. 500 people signed NDAs for that transaction. We had to shut that off. We had 30 offers for that business. We had to shut that off. And, you know, when you get that level of people interested in the business, you know, because it was a good business, you just simply cannot answer everybody, and it makes people upset. But the good news there is that you know, if you're a buyer and you want to be aggressive, you're going to be able to beat out everybody else because you're being aggressive and because you're putting the money up that you need to put up. For a seller, you're getting the best possible structure, right? And so when you have that kind of demand, you see those best structures. Let's see. If you stay on after selling the business, can you expect to receive a salary, or do you work without salary since you receive payment for the business? Good question. So it kind of depends. If you want to stay with the business, they're more than happy to pay you a salary. But there's a caveat. If you decide that you want a big salary after closing, they're going to say, no problem, as long as this market will pay you. But we're going to pull that out of your SDE or your adjusted EBITDA when we value your company, because we're going to have that as an expense. You may have added back that expense of whatever you were paying yourself before, but you can't win both ways, right? I mean, you can't have it as an add back, receive a multiple on top of that, and then also get it as a salary after the fact. Now, if the salary is pretty low, call it $100,000, pretty reasonable. It's something that we can oftentimes negotiate into the transaction as we're horse trading so that it doesn't negatively impact your SDE and you're still getting that. But understand that a lot of times there's a tax benefit to receiving more of your money through an add back when it comes to your income versus trying to get that income after closing, because again, you're getting a multiple on top of that income for the sale. Plus, you're getting a long-term capital gain, which is much better than ordinary income tax, which is what you receive whenever you get paid normal. So hopefully that helps explain that. But if you have any other questions, I'm going to have to jump here to the end. Go ahead, Ron.
In that particular one, in a normal case where a seller is selling and then they're going to go their own way afterwards, you're going to probably work for between 1 and 3 months for free. Okay, that's part of the training. If they want you afterwards, then it's negotiated out. So just on a normal sale where you're not staying on afterwards, expect to work for free for a little while.
Good point. I know we're here at the end, so I'm just, we missed a lot of this, but we will provide the slides here. And of course, this is our contact information for anybody that wants to reach out to us. I'll just leave this up here. You can reach out to us for any questions that you have at all. Just to be clear, we don't charge any fees for having consultations or anything like that. All 4 of our firms are 100% commission based, which means that we don't actually receive a commission unless we close your business. So it's not uncommon for us to work with people for years before we actually go to market and helping them prepare. And we actually enjoy doing that a great deal. Because by doing that, we're also helping ourselves, right? Because our job is to get the highest possible value for your company, and we win and you win in doing so, because again, we are commission based. So please reach out to us for anything. We're here as an asset to you as a business owner, and happy to help.
Fantastic. Jason, Ron, thank you so much. Clearly, there was a lot of great questions, so a lot of interest. Please reach out to Jason and Ron if you have additional questions or you want to follow up. They really know their stuff. And don't forget to register for next month's event. I look forward to seeing everyone there. Thank you so much, guys. Anything you want to add?
Appreciate it.
All right. Have a good one, everyone.
Bye-bye.